Thank you for joining us. This is the Traders Exclusive Live Trader Showcase. I'm Sherry. Please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. So before we get started, I will share the quick disclaimer. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time, and past performance is not necessarily indicative of future results. Many thanks to our sponsors for the June Live Trader Showcase, Market Taker Mentoring, TechniTrader, and Money Mentor. Please go check them out at markettaker.com, technitrader.com, and moneymentor.com. Thank you again.
Hi, everyone. Get out your pen and notepad or type on your computer if you have a Word doc or something. You need to take notes. I am like a fire hose of information, how to trade any market. I'm an educator. I do this in my retirement. I love to teach, and I could be doing anything. And my peers often wonder why I do this. I come from the buy side. So most of the people that you are learning from don't understand the buy side. So what I contribute to your education, because everything you've learned is valuable, is that what do professionals like me do? How do we handle the market and how do we deal with it? And she's already given you my credentials, so I don't have to do that anymore. And so how to trade any market condition. Have you ever had a strategy that you were using that was great for a while, and then suddenly that strategy stopped working? Anybody? Have you ever been trading stocks with good success and profits, and then suddenly you have loss after loss and don't know why? Have you ever backtested a trading strategy or idea with great success on a simulator, but then when you go live trading in the market, all you have is losses? Do you believe that the stock market is volatile most of the time? How many people feel the market is volatile all the time? That's a common misconception right now. Are you beginning to think trading is just too hard, or the market makers are out to get you deliberately? They're way too busy to go after your 100 or 500 share lots. You're not alone. In fact, most retail traders have the same experiences, problems, frustrations, and losses. And it comes from the fact that you're learning everything about the retail side of the market. This is how the retail market day trades. This is how the retail market does this. This is how the retail side does that. The retail side only accounts for about 20% of the whole market activity. If you don't understand the 80% that's hidden from you, then you're going to struggle no matter what you do. What are market conditions? The true problem is there are huge gaps of missing information in your education. You have some basics from the internet and webinars, but you're lacking far more than you realize. There's an entire world within the internal market that you have never heard about or heard very little about. If you want to earn the prestigious status of trading as a business, as professional traders have, then this webinar will help you achieve those goals. So trading as a business is something that I'm promoting quite a bit amongst my retail groups. I teach a lot of professional traders, but you also can trade as a business, and then you can deduct everything off, and it's a total asset for income taxes. It's not strategies or backtesting or volatility or market makers. What is missing is an education which focuses on the methodology essentials for successfully trading stocks. Professionals have acquired this education from the professional side of the market, which is generally not available to you. There aren't any trading programs in the universities or the financial services industry where we have bachelor's degrees, master's degrees, doctor's degrees. So they have to come to me or other CMTs to get that. Market conditions are just one area you need to help with learning about using it to your advantage. It's the most important of all the missing pieces about stock trading and what you have learned thus far, because this is not included in anything that you've learned. Market condition analysis is the climate or ecosystem of the entire market. I'm trying to get you to relate to this because I'm really tired of the misinformation of predicting the market, predicting the market, predicting the market. I want you to write this down. You want to have the highest probability of success. You want to try to attain a 95% probability of success with each and every trade that you do. And if you do that with a probability, then rather than trying to predict the market, you will have success far beyond what you have right now. Trading conditions is the day-to-day weather. This is when you choose a style and apply the appropriate strategy. A lot of you are learning strategies, but first you have to have your trading style, and then you can apply strategies to it. Predicting is impossible and tends to give you the wrong perspective. You're thinking the wrong way. You're thinking, oh, the market is going to go up. They're predicting the market's going up, or my chat room is predicting the market's going to go up, and then it doesn't. You want to have, we are successful and we make huge amounts of money on the professional side because we use probabilities. We never, ever predict. What you need is just like a weather forecast, a probability to a very high degree of how the trading condition will be for the next day or week. That's about far out as you can go is about weather. So it's the same thing. Foundational knowledge. There are 6 primary market conditions. Can anybody name them? I know if I have students in the audience, they can name them. The bottoming market condition, the platform market condition, moderately trending up or down, both directions, velocity up or down. So at times when it's a bull market, it'll be moderately trending up, velocity trending up. When it's a bear market, it'll be moderately trending down or velocity trending down. Topping market and trading range market. Each market condition is unique. The trends, trend line patterns, which I teach you, are different. This is because different market conditions are created by different market participant groups dominating and controlling how price moves up or down. And I will explain this. I'm going to go through each one of these. Please write down some of this information so you can retain it. Market condition is your weather forecast for navigating the market activity. Where are we? Are we in a moderately trending? Are we in a velocity market? Are we a topping market? Right now, everybody says, oh, the market's volatile. We're in a volatile market. Okay. Those are the 6 primary market conditions. Which one are we in? Do you know? Right now, we're in a sideways or platform market condition. We had been moderately trending up for a while, but now we're back to that. You will trade differently in a velocity market than in a platform market. Why? Because velocity, think about what I'm saying when I'm saying using the term velocity. I'm not saying volatility, I'm saying velocity. And a platform market is different. I'll show you in a little bit. The stock market cycles and each market condition is a different part of that cycle. So I'm not going to go through this. I've done this last time and you can check it out or you can come to my website and I have training right on this. We don't have time today because I want to get to something else. This is the bull cycle. Retail is about 20% of the market activity and all of these groups impact and control price as price reaches its pinnacle peak, whether it's the weekly chart, a daily chart, or a monthly chart, or an annual chart, or many years chart. 80% of the market activity is controlled by the professional side. High frequency trading trades into and provides the liquidity for the retail side, but they are on the professional side and controlled by the SEC. All of these also contribute everything and they get in at different times and have different aspects of control. When they're in control, price changes. And when you look on the charts and you can recognize which market participant is in control, then you will make better decisions. Bull and bear markets are not just inversions of one another. They're really different. A bull market typically lasts 8 to 15 years, and this one could last longer than any other because of the new technologies. There's 20 new technologies coming to market. It's a staggering number. A bear market averages about 1.2 to 1.5 years. The last bear market we had lasted about 3 months. So it can be all over the place, but it's short. There are different kinds of bull markets. Minor bull market is a long-term uptrend of a few years. There are no new technologies going on at that time. Minor bulls are caused by other financial markets such as real estate or bond or commodity or cryptos having their bull market, and it impacts some stocks. The average bull market has some new technologies that are helping boost not only the stock market, but also other financial markets. We had that in 2010, 2012, 2013. A great bull market endures far longer, has greater return on investment and trading gains, and new technologies create the bull market. The last great bull market we had was in the 1998, late 1880s, and into the 2000 year 2000. So it was like 1988 to 2000. And that was the end of that great bull. We have a bigger one coming. So bear market cycles trend down, and they trend down far faster than the uptrend. It only takes 1.2 years or less nowadays, and they're going to get shorter and shorter. So you need to be aware of that, because a lot of you try to sell short too late. Bottoming market condition. The bottoming market condition is exactly what the name implies. The indexes and broad base of stocks have been in a bear market or an intermediate term downturn correction. How many stocks do we have right now that are broad base? We have 6,700 stocks that are not components of an index. We have 3,300 ETFs. So we have a huge amount of activity that goes beyond the indexes. There are many shapes to a bottom. They can be a bowl or rounding, triple, V, U, and basing bottoms. There's all kinds of them, and they all represent different activities. Buy-side giant institutions tend to create the bottoms. When stock prices fall below fundamental values, dark pools start buying bargain price stocks. During bottoms, retail groups are afraid of the market and will go down more. And so retail groups hesitate and often sell at or near the lowest price of the dark pools are buying. Retail news is full of fear, negativity, and misinformation. We've had lots of misinformation and lots of negativity. Oh, the economy is lousy. Oh, the world is coming to an end. But dark pools have been accumulating vast quantities of stock, and they're building a lot of ETFs. So this is where the fundamental values actually were for the stock, and it was pushed down because sellers sold, and then there were people who were selling on the bounce. So it bounces up and they sell because they're losing their money. So they're going into it wrongly. So if you try to sell short in this last episode, where we're starting to see some accumulation going on, you're going to be battling in your sell shorts the buy side giants. And since they have $143 trillion, that's a T trillion of assets worldwide under management, under US control, they really have the bigger half of the advantage. You don't want to be trading against them. This is a bottoming market. It accelerates as it goes down. We have a lot of speculation going on here. We have some people buying on the dip and running up and all kinds of things, but there's also some pro traders activities. We have the dark pools entering right here. We can have their buy zone that we can see. Pro traders do nudges that causes stock the price to move up and create these nice big runs that you want out of a bottom. So when I say it's a bottoming market condition, we want to start looking for the tail end of the bottom when it starts to complete, and it would be completing right in here, because we're going to have some momentum runs, because the pro traders catch the dark pools activity, and then they start nudging that price up, and then other smaller funds and other professionals will get in and start buying that stock, and then it'll correct a little bit, and then this is another nudge, and then it'll run right back up. So understanding what's going on the dynamics of the chart beyond, oh, well, this is an engulfing Y. Oh, this is a reversal pattern. Those aren't going to work for you anymore. The market has changed dramatically. We are not the Japanese rice commodities exchange of the 1600s. We're the US dominant stock market of the world, and bar none, with larger than all of the others combined. And we control vast amounts of wealth, and you need to get in on it, because the small middle class is shrinking. So you want to look at this and say, who is in control of price? Who is in control of price? Who is in control of price? And that will give you an idea of how you can trade that and understand what's going on. When we have a velocity run up, that is controlled by speculators and hedge funds and smaller funds and some retail who get in and are able to take advantage of that because they know what they're doing. Platform market conditions follow a bottoming market condition pretty much always. The platform market condition is taught only in the TechniTrader courses because it is not something that is taught in technical analysis generally. Platform market conditions started to appear in 2002 when the market switched from fractions to decimals. That's what created it, is we went to decimals instead of fractions. It used to be that you could scalp. You could go in, and I had a trading floor, and you could go in and scalp 50 cents or 75 cents or 100 cents and swing trade intraday and make a lot of money. You can't do that anymore because there's penny spreads, and those penny spreads create a very interesting platform pattern. Dark pools strike the penny or half penny in a narrow price range, creating this new type of trend, which is wider and longer term than a consolidation, but has very distinct highs and lows. And when you're able to recognize that, then you can go, oh, dark pools. Now, who follows dark pools? Professional traders. So I want to get ready for what? Swing trading, because you may be swing trading 100 shares, or you may be day trading 100 shares, or 200 shares, 500 shares, 1,000 shares, maybe feeling really lucky. But they're trading 1 million to 5 million share lots because of the penny spread. Dark pool TWAP orders create this market condition. Buy-side giants create and control the platform market condition. Professional traders search for these patterns to create the head nudges and triggers that move price upward via HFTs and smaller funds managers buying thereafter. So that's a platform market condition. That is not a volatile market. That is a platform market condition, and it's a specific way that you have to trade it by understanding who is in control of price. Now, I teach platform position trading as a style, and so they get in early, and then when it gaps up, they've made a lot of money. They may choose to hold a little bit longer and gap up. Sometimes it gets into an intermediate term trend style, and they can continue to make up and make a lot of money, but it's still on a short-term trend. Moderately trending market conditions tend to follow the platform condition or a trading range conditions. Trading ranges are a very wide, and I'm going to talk about it in a little bit, but it's a very wide range. The moderately trending market has a steady uptrend and many years and show up during the middle years of a long-term bull market. Frequently, minor to intermediate term corrections are common and maintain the integrity of the uptrend over many years of time. So we have, this is right, just last week, I just grabbed this stock, and we can say it's been going up and it's going down, up and down, up and down. Everybody says, oh, it's volatile, oh, it's volatile. No, this is normal. You just need to learn how to get in here and pull your money and recognize when the pros are selling out, or switch to a platform position and then hold through those minor corrections. This market is dominated by professional traders setting up triggers that initiate HFTs, small funds, and later retail traders and retail investors, and always buy late. You're always buying late. Momentum is reasonably stable for swing, momentum, or platform position trading, so you can do any of those styles at any time. Retail groups often mistake minor corrections for a bear market. Oh, a bear market's coming. I mean, I must have gotten 2,000 questions off of Quora. I'm a big writer there about, oh, is it a bear market? It's like, no. This is a moderately trending, uptrending market condition. This is an extreme exhaustion pattern, and it's going to correct down. So you can see that it goes sideways a lot. What's happening is we're calling a volatile market what is actually a sideways market. It's either a platform or consolidation. Tons of that. That is common because we're striking the penny. We don't see the peaks and valleys trendline patterns anymore because it's a different market condition. Velocity up market condition. The velocity market condition is the shortest of all the conditions, lasting a few days to a few weeks intermittently during a bull or bear market. Panic sets in and everybody starts selling. Oh, this stock is going to go up forever. I got to buy it. And then, of course, the pro traders are selling and you lose. Velocity, like moderately trending, can be either up or down. Velocity up trending market conditions occur when the retail traders, retail independent investors, foreign and sovereign funds are buying speculatively. These groups have minimal to no real education and limited experience. They don't know what they're doing. They just see the stock is running. Oh, we got to get into the stock. Well, you need to get into it right about here or right about here, and then let it run up. And that's a problem. If you're day trading a very tight range like this, you're going to get whipsawed out. These groups control the velocity runs, which often have no overlapping candles as price tends to open up or slightly above the previous day's high due to rising overnight order flow from retail groups. Couldn't find a chart with that, but basically what you would have is you would have a little minor gap between all the pricing. And it's stunning to see. And that's a velocity market condition. It's not volatile, it's a velocity. It's like a rocket leaving planet Earth. Okay. The angle of ascent warns traders that the trend is too steep to sustain for long. So what have you got to do? You've got to ratchet up your stop losses. You've got to place them carefully and strategically intraday if there's a really long candle. And if you're following around a swing trade, you've got to be careful and make sure that you've got it well below that wick, because that wick is the natural movement up and down of the stock that day. You get in the way. Professional traders always sell with great care, creating tiny resting day or profit taking day candle patterns that you assume are something else. Velocity market up or down. This was a trading range market condition. This is volatile market action. Up a couple days, down a couple days. Trading ranges are always volatile. This is a velocity market up, and you can see that it's moving up, moving up, moving up, moving up, and it'll stop here at this resistance level. But something triggered that, and you could ride those up if you know how to enter appropriately with a low risk, high probability of high profits. The trading range market condition is the most challenging market condition to trade. It can develop on the intermediate term trend or the long-term trend. The longest and worst trading range market started in the late 1960s and ended in 1982. There were no new technologies during that time. We had lots of problems going on, lots of conflicts, leveraged corporate takeovers, and skyrocketing inflation with oil prices soaring are the cause of such a long trading range market condition. In the 70s, gas was at 35, 45, 50 cents, then it suddenly jumped to $3 a gallon. Inflation ran 12, 15%. If you wanted to buy a home in the 80s, you would pay 15% on a 30-year fixed. We don't have that kind of inflation right now. Also, there were no new technologies of significance occurring during the era. Trading range market conditions occur from time to time and usually are a correction phase on the long-term uptrend that is very wide. Special training is required to profit during a trading range market condition because it's so volatile. Typically I encourage my students to do, because no matter what trading condition you have, there's always going to be some that are working really well. So this is a trading range market condition. It's very volatile. It has ups and downs, but trading it is tough because every time it stops lower or higher, that becomes a resistance level. So trying to trade these, if you have these kinds of things, you should be very careful, because even intraday, it will whipsaw you because of what's going on. The topping market condition occurs at the end of a bull market. The great bull markets of prior eras were 1929 and 2000. Both great bulls occurred due to numerous new technologies of those eras, all coming to market, to the consumer market and small business market within the years of those great bulls. What is important in a topping market condition is that all of the retail side of the market ignore the warning signs. All the retail groups believe the market will go up and up and up. Speculation has become irrational, exuberance, and euphoria. When everyone thinks that prosperity will go on indefinitely, that is when well-educated traders and investors start selling their stock, as a great bear market always follows. This is the Dow of 1929, 82% loss. This is the bull and the bear of the NASDAQ. And it was a pretty good sized loss as well. So when we have angles of ascent that are really steep and everybody's saying, oh, the market's going to go on and on and on, then you got to be worried. So topping market conditions occur, and they are formed by dark pools seeing that a company has reached market saturation. Apple has reached market saturation for its iPhone quite a while ago. And so it topped because they saw it and they started slowly rotating out, lowering inventory so that they could move over and get a new, small, high-powered, smart little company that's going to be the next blue chip company. So if you follow the buy-side institutions, they're always getting into the small caps that are going to be the next generation of big blue chip. You need to learn why and how each of the market participant groups affect price and volume. Each group has a distinctly different footprint on the stock chart. The size of the candle, where it forms, whether it has wicks and tails or not, tell you who controlled price at that time. The professionals don't create wicks and tails. So if you see a chart with lots of wicks and tails, you can just be sure that that's controlled by retail or smaller funds. Within each group, the trading activity is very similar. So buy-side institutions tend to all buy the same. Professional traders, we all trade very similarly. Smaller funds are uneducated. They're mostly salespeople, and they're just trying to make a lot of money, and they do very badly. Memes groups are all managed by a guru who says, okay, at lunchtime, everybody buy this stock. You must understand the wide disparity between the groups in terms of venues. Are they trading the public exchanges or the dark pool ATS venues, or buying directly from the company? Dark pools can buy directly from the company. You can't. Dark pool ATS venues, there's 50 of them. There's only 13 US public exchanges. But that's because all the money is on the dark pool side, 80% of it, and you can't see it. And if somebody says, oh, this is a whale surfacing, no, it's a small funds manager. He's not even on the retail side. He's not even considered professional. What order types do they use? Speed of execution, access to information, lot sizes, and intent of the trade. Everybody, every single market participant group is uniquely different, but the group trades very similarly, or buys very and sells very similarly. Over the past few years, the financial markets, especially the stock market, have fractured into a multi-venue structure that has never existed before. Relational technical analysis makes it easier to recognize each market group's footprints in the chart, and that's what I teach. The buy-side giant institutions are the most dominant and influential market participant group today. They control vast inventories of stock in thousands of companies. When they accumulate, the price is predetermined and is in a very low, narrow penny strike price range. I call these the buy zone. So if you see that on the internet, that's from me. It can take weeks to months for the dark pool to buy all the shares of stock for a mutual fund or an ETF. They have to build these units. Professionals, independent traders, and floor traders or the banks are constantly searching to find dark pool buy zones to create a nudge that will result in a gap or swing style or velocity style run for a few days to over a week. They get in early and then they let the stock go up and then they sell at the top. You need to learn to trade with these professionals rather than against them, as you are doing right now. I can assure you, you're doing that. So, professional floor traders, prop desks, independent professional traders. A professional trader is very different from a retail trader. They are aware of the entire body of the market participant, what each is doing, and how that market participant impacts price action. They're aware of who they are trading with and who they are trading against. Professionals use special order types and commonly trade 1 to 5 million shares in a single transaction, and they spread it out and they have as many as 10 legs on their orders. They use special indicators designed to identify which side of the transaction the large lots triggered, because that's what they're going after, the large lots, not the little small lots. Independent professional traders hunt for dark pool buy zones. They create candlestick patterns called nudges, which trigger HFT automated orders. The HFT is fully automated. Market condition analysis. Who is in control of price of those 12 different market participant groups? What technical patterns are prevalent and reliable when they control? How price will behave at support and resistance? It's not the same every time. What trading style works best? Which indicators you should be using or how to tweak them for that trading style? The inherent risk in trading specific styles for that market. Sometimes it's just too risky to trade certain ways. And trend line patterns are common. Which entry signals are most reliable? You want to be using entry and exit signals, not reversal and continuation patterns. The strength of price and volume patterns matter. Price is your most important indicator. Market condition analysis tells you how and when to trade, who has control of price, what to expect in near-term price action, where to find excellent picks, how to enter, and when to exit. Wow, I have a roadmap of what market participants are actively trading, which are sidelined or waiting, where we are in the overall long-term, intermediate-term, and short-term trends. This provides the relational analysis to navigate the complex marketplace. So, example for trading market conditions. Years ago, I had a trading floor and I needed to be able to be far more accurate. And I realized very quickly that futures were good to let you know how the market opened, but the rest of the day it was like throw up a bunch of cards and guess. So I created these analysis scans, and I said, give me all the stocks with very high momentum to the upside. Give me all the stocks with a very high momentum to the downside. I compared those two. When I compare those two, it gives me the bias for the rest of the day after the futures are over and the market really begins its trading. Then I said, give me all the stocks that have dark pool buy zones. Where are the buy zones? Give me how many are there? And I can see the HFTs chasing those. And then I say, how many stocks are in bottoming position? How many stocks are bottoming? Tell me a lot of information about the overall market condition. And then I ask how many stocks are in consolidations. That includes the platform and the consolidation, tells me where the pro traders are trading and what's going on there. Then I go, how many stocks are in a trading range or moving down or trending down. And this tells me if we're at risk. The two sell side scans tell me if we're at risk of heading into a bear cycle or intermediate term correction. And these scans are amazingly, my students say they're very dead on. I haven't ever tracked it. And then my last one is relational. Is price improving over the so many days? Is it improving or not improving? Is it sitting still? This tells me what kind of underlying momentum is going to end up showing in the momentum scan in a few days. So by analyzing this, I can tell the market condition, what market condition we're in. We're right now when we're in sideways market, platform market, sideways for the indexes. We have moderate to low momentum, so we got to watch our swing trading. We have a lot of platforms building. We have a lot of bottoms that are building, that type of thing that are going on right now. So that's the market condition that we have right now. I give this out every day. I write 2 reports in the morning. One's the market condition report that tells all the bias, the strength of the bias, the energy, what we're going to see for the day, how to trade the stocks, a couple stocks to take a look at, that type of thing. Tools for trading any market condition. Your arsenal of tools is probably lacking quite a bit of these things, and you need to have them. If you want to trade as a business, you need all of these things. Trading as a business gives you a special IRS status. That means that you are actively trading like you're a small business. You can take off all the small business expenses, the deduction. Your education is totally deductible. All your trading expenses are totally deductible. Your office is deductible. Your computer is deductible. It's pretty slick. And they did that because they realized that some people are very serious. Market condition analysis. You have to understand not just what the futures say the market's going to open at, but what is the condition of the market and how it's going to behave today. What's the bias for the day, trading bias. Relational technical analysis tells you who's in control of price at any given moment if you look at the charts and study the relational analysis to the price action and so on. Trade Management Planner is a way that my partner, Howard Johnson, developed this a few years ago. And I was wowed by it because it was so cool. And it manages it. You set yourself up each month. You know how much money you have to trade. You have your range for your parameters of what price you're going to pay for your stock. You have you enter the stock symbol and the price and everything, and it just fills it all out. It tells you how many trades you have to make the month, how much money you can make, how much capital you need, how much risk you're taking. It's just magnificent. Daily trading journal. You have to have a daily trading journal. I share my trading journal with my students, and so they can compare what I'm seeing in my trading journal to theirs, and it helps them develop a good trading journal. You have to have that. Charting software that includes scans and sorts. You can't use free charting software off the internet. It's just not enough. Hybrid leading indicators. Hybrid leading indicators are tracking the dark pools. They're saying what side of the market is the dark pool on? Where's the large lots? That's important. Controlled bracketed order types. Some of you use app market. Most of you don't. Most of you use limit orders. Well, that's buying into weakness. And so a lot of times you'll place your order and you'll get in at a better price, lower, and then the stock goes up a little bit and then moves down the rest of the day. You have to have a bracketed controlled order because the market makers will take advantage of that because they're trying to get money off of the penny spreads. So be careful with that. Buy entry signals, sell short entry signals are imperative. Reversal and continuation and Japanese candlesticks are great, but they don't tell you what is a actual buy signal. What I mean by a buy signal is the pro traders are already in that stock. So you better get in it now, okay? A sell short entry signal is, oh, the pro traders are selling now. It's time to take your profit off the table. Exit signals or trailing profit stops for taking profits. I like to use trailing profit stops. If you don't think that stop losses and trailing profit stops work, It's because you're using percentages and that never works. You have to use the proper support levels or resistance levels so that you have the stop loss. So it allows the stock to breathe and move up and down naturally, but not get you whipsawed out. Run gain potential calculation. How many points can you make in this run? Do you know? Or do you just say, oh, that stock looks like it's going to go up, so I'm going to buy it. Or that stock's been moving up, so I'm going to buy it. But do you know how far it's going to go before pro traders start selling? It's in the stock charts. You can calculate the run gain potential, and the trade management planner will do that for you. Trade calculators, that also calculates the automated risk analysis for you, technical trading style stop loss placement. So the trade calculator does all this for you. Entry price for controlled bracketed order types, and share lot size, price range, risk of profit to ratio, estimated hold time, and exit point. So the calculators that Howard created and everything for himself, I shared with my floor, and then I share with my students because it takes all the hard work out of trading and makes it fun. And you don't make the mistakes of guessing. So retail side pinches pennies. Oh, I don't want to spend any money on a charting software. Oh, I don't want to spend any money on education. I just want to go around the internet and get everything for free. Professional traders spend a lot of money on their software. They spend a huge amount of money on their proprietary desk activities, and they spend a lot of money getting an education. And so they make a lot of money. Okay. I get lots of these. I wish to God I had gotten here 17 to 18 years ago. I hear comments like this all the time from my students. The single biggest mistake that retail traders make is to assume they can figure this out on their own. A supportive, comprehensive training course is mandatory if you want to succeed in the modern automated market. Without a trading process that gives you a complete step-by-step detailed roadmap to consistent results, you will lose more money than you make. Do not struggle for years and years, and all you would do is end up eroding your capital, your confidence. It's far more difficult to get rid of very bad habits than it is to learn how to trade correctly in the first place. Give yourself the gift of a good education because you deserve it. I have people coming to me all the time that have been trading for 10 or 20 years. They've spent 50, 100,000 or more dollars trying to figure it out for themselves. They finally get there, they take the course and they go, why didn't I take this 20 years ago? I have beginners who start out and they say, I really need a good education. I can't figure this out for myself. And I say, well, that's a good way, and let's get started. And they're successful right off the bat. The TechniTrader difference. You are learning from professionals. We're credentialed. We have been in business for 26 years. TechniTrader staff continually update and improve the quality of our education. We keep our students up to date with all the new trading instruments, changes to the internal market structure, and how professionals are trading the market. A lot of you are taking courses that were written in 1990s, and they don't work anymore. We have communities and discussion groups with both professional level studies, and beginners can share ideas. So that helps the beginners because you get to hear from some of the pros that are in there, and it really helps you out. Because I have so many people that are doing so well, it's a very intense and interesting area to be in. TechniTrader has the most extensive support, guidance, etc., with access to a vast library of help files, articles, and ongoing new information about the evolving market structure. It's changing, and it's changing very rapidly. It changed dramatically during the pandemic, and it's continuing to change. We offer 3 different courses designed around your individual trading needs. What you've already learned is useful, but you have to fill in your holes. Some students advance to the professional level and work for institutions. And that's nice. The course can be taken at your own pace when you have the time and when you're ready to learn. Our courses contain the body of knowledge and experience and expertise of our founders. This foundation of knowledge is taught nowhere else. So there's a lot of people out there teaching day trading, and that's great and fine, but you still need your foundational knowledge. So we have our TechniTrader communities and everything, and they're really very active, and lots of people talking and discussing. Sometimes I'll put a little homework assignment out there, or I'll do an in-depth analysis of a chart for a student that's really popular, or they want to go into a long-term position, and so I'll do a long-term full analysis for them, and that really helps them. What we have is mini courses. Take the mini courses. It shows you how we teach. It shows you how you will learn. You'll learn a lot from the mini courses, even if you decide we're not right for you. But if everyone who takes our course is just blown away by how much they don't know and they need to know. So I will answer any questions that you have right now. I'm going to talk a little bit more about the dark pools and the HFTs and what's going on with them. Right now, they're in a heavy accumulation mode, and they're quietly accumulating. We have quite a few bottoming stocks that are going on, and there's a large number of those that are happening. And so you want to consider taking a look at that and studying that. If you're just beginning and you're just starting out, I would start with some basic introduction. We have about 8 of these mini courses. If you are someone who's a professional and you want to learn about the trading plan that Howard created, this one is a really great one. We also have candlestick chart patterns. This will introduce you to the new Western candlestick patterns that we teach, the buy entry and the sell entry signals that are the pro trader signals, the stair-step trend line pattern, the runaway trend line pattern, where you need to do support and resistance, where you need to do all different kinds of activities. I can bounce on back here to, since I have a little extra time, go back to some of the other things since I have extra time. Okay, so let's talk a little bit about this bull cycle of market participants. The bull cycle of the market participants, the buy-side institutions get in here at the low point. They're always looking for bargain price stocks, not cheap stocks, but stocks where the fundamentals are above the price. And we have a lot of billionaires, and they have the greatest money managers in the world, and they also buy at very bargain prices. These are long-term investors, okay? And they control $143 trillion or more. Professional side traders for the sell-side institutions sell short and buy long for the buy-side institutions, sell-side institutions. The professional sell-side institution traders also do the buybacks. Right now, we're having a lot of buybacks. So if you're interested in finding some really fast velocity run activity, you want to learn about the buybacks and how that footprint pattern shows up on the stock charts, because that is a velocity run oftentimes built by these. The professional traders on the buy side and the independent traders, the professional traders on the buy side, trade for the institutions. The buy-side institutions like Vanguard, Fidelity, BlackRock, State Street have huge floors. I've been on some of them. And their traders are trying to improve the return on investment. So they're trading short term to improve the return on investment and make more money for the company. The professional independent traders, where you would also be allowed to participate in that, would be if you were trading as a business. And I have some students who trade as a business, and they are able to trade actively and do as well as professional traders. The professional traders used to be floor traders, and now they moved on and become very independent. They actually are now also providing some services to market makers and to the buy side as an auxiliary way of making more money as well. Corporations buy companies when they are interested in either acquiring the stock or investing in it. They can be investing in a small company, not necessarily to take it over, but to help it grow. And also corporations do their own buybacks, but they don't actually do the physical buybacks. It's the professional floor traders of the sell side that do the buybacks. And the buybacks are designed to boost the price up, to push the price up and up and up, so that their stock looks better than the fundamentals will tell it to be. High frequency trading and hedge funds are the maker takers of the market. They provide the liquidity of the market activity, providing a lot of activity so that there's some liquidity on the retail side. If it wasn't for high frequency traders and hedge funds, the sell side would be very illiquid, because all of these others are on the dark pools. They are not trading that. Sometimes the professional traders on the sell side will make the market to the retail side. So they control 80% of the market activity, which is huge. It didn't used to be that way. In the 90s, it wasn't. So retail side, you have a lot of small asset management and small funds and small hedge funds and AAII, investment groups, all trading very similarly. They have very limited amount of education and they don't believe in technical analysis. So they're missing out on a lot of information. They buy in chasing the HFTs, thinking they're buying the dark pools. You see how far off they are from that. Sovereign funds, foreign funds, and nonprofit funds. We are the largest stock market in the world. We are the stock market that has thousands of stocks to trade and invest in, and ETFs and everything else. Everybody wants to buy our stuff. Yeah. So they're in here and they're buying, and they also have limited knowledge, so they often buy a little bit later. Memes groups and retail traders are groups that are managed by mostly by either a teacher or somebody who's a guru. I'm not a guru. I'm an educator. And they all buy the same way. So we can tell when they're trading because it's all the same way. And they're often scared. They're trading and they're absolutely terrified of losing money. So they often cause long wicks and tails. Small lot investors always get in late because they're scared of the market until it actually starts moving with velocity and momentum. So they always buy very late. A lot of people are buying stocks late right now. Then we have retail trading chat groups who they're public. And so the high frequency traders can hear and see. And so their programs pick up whatever they got, those groups are talking about in the morning. The HFTs also pick up all the retail news and all the activity that's going on there. And they go, okay, we'll just front run these. And so what happens is they gap the stock up or down based on what these groups are telling them, because you're in social media, you're in whatever platform that's open, and they go in with their deep mining data and they get it and they go, okay, we'll just get into the stock early and go out. Odd lot investors are people with very small capital bases, no education whatsoever, and they're just hoping that they can get rich quick. They always get in at the top, very speculative, very gambling mode situation. When you become a semi-professional trader, trading as a business, then you enter the realm of being very respected and very treated very differently. When you're just trading in a chat room or day trading, trade trading is super, super popular. But you should check out the SEC and what the SEC has to say about day trading so that you can be aware and consider all of the ramifications of that, because it is far more difficult than it was in the 1990s. And I get a lot of core questions from day traders because they're losing money. And I'm talking about thousands of questions on how do I make money with day trading. And I'm saying, well, why don't you try swing trading? It's a whole lot easier. The problem with day trading is a lot of the stocks are illiquid, or a lot of the stocks are in rotation mode. If they're famous big blue chip stocks, they may be in rotation mode, but you don't know that. So you're trying to buy it long, buy it and trade it for it to move up. And dark pools are rotating out of it. They're selling. The pressure on the sell side is far dominant, and then you will lose money. So that's how that system works. On the downside, when we're looking at the downside market, want to stay there. Okay. The same thing is happening. The buy-side institutions are getting out early. They see that the company like Apple has reached market saturation. They were selling a long time ago. They've been selling Tesla because they want to oust the CEO. They have huge influence. They can go, okay, Amazon, you need to give a dividend. You're a big company. You're the only big company that's not giving a dividend. We're going to start lowering our investment in your company until you give a dividend. And sure enough, they're lowering they're rotating out of Amazon slowly, carefully, not really moving price. They don't really move price. That's the secret of it, is that you can't see them because their price action is so narrow. You have to really be able to identify it with the large lot indicators and volume and all the other aspects of it to get that. So it's a combination of price and large lot versus small lot, and uptick versus downtick to get that buy-side institutional activity. But once you see it, it becomes very easy. I tell a lot of people it's like reading sheet music or reading anything that's, once you read it, it is a language. It is a language. The charts are a language and they're telling you something. And most of you focus on just one or two candlesticks, and you should be focusing on several candlesticks or several runs up and down to evaluate what you're doing and how much run gain point potential or profit potential you have. When you start looking at it in the terms of probability rather than predicting, oh, everybody thinks this stock is going to go up, so let's sell it. Well, by the time everybody decides they want to buy it, all the professional side are already positioned to either sell short or to sell out. And so then the pressure's on the sell side and it's going to go down. So you have to be very, very aware and very careful of that and know that you need to go beyond what you've learned. Everything you've learned is very good. Everything you learned is helping, but you come to these to get more help, more knowledge, more information. And what's lacking is that you just don't know anything about the professional side of the market. And as long as you have that huge gap in your education, you're going to have hit or miss. It's not going to be consistent. My students work on the simulator until they have a 75% success rate, and then they can move to the market. And then I say, okay, now it's an 80% success rate. Okay, now it's a 90% success rate. Professional traders have a 95% success rate. They only have 5% of their trades are losses, and they minimize that loss and minimize that risk very quickly. So they don't take huge losses. So in the end, they make a lot of money at the end of the year, and they make a lot of money for their company or for themselves. And they trade very differently than you do because they are taught by professionals. They understand the professional side of the market. They recognize what's going on in the market, and they're willing to invest in their education so that they can stay current with all the internal market structure that is continually changing. It's something that I focus on with my students so that they understand constantly. I write a lot of training every single day that is fresh and new, and it is based on what the students are asking and what they're looking for and what they need more guidance on and that type of thing. We have an amazing staff who is very supportive of the students, and we do very, very well with them. So I again would recommend that you try to go to our website, TechniTrader.courses, and register to watch some of the free minis. They are going to be really useful to you, and you'll find out that you have a lot of knowledge just from those free little mini courses that we put together for you. When people go through the whole mini courses, they just love them. They feel like they've learned so much, and it's very, very beneficial to them. So try that out and see what you can get. I'll take any questions if we have any questions now.
Right. We don't have any right now, but I have prompted everybody to ask their questions because I know our time with you is limited. I did post your link into the entire chat, and it's a beautiful site, you guys. You got to go look at it. It says grab your webinar gift, one per person, use your coupon code. Now, do we have a coupon code to give them?
Is our host around?
That's
yes, it's actually the last part of that link. It's LTS 0624. That's your coupon code.
Oh, cool. Martha, you can't hear me? I don't think she can hear me.
If you do have any questions, you can email me directly at info@marthastokes.com, and I will get that. I have a box that I will open up for you, and I will answer your questions there since we don't have a. Thank you very much for participating, and come visit us at our website. I'm Martha Stokes. Thank you. Have a good day.
That was Martha Stokes of TechniTrader, and she is one of our sponsors for June. That was so awesome. She is a fountain of information, and you're going to want to go look at that. Many thanks to our sponsors for the June Live Trader Showcase, Market Taker Mentoring, TechniTrader, and Money Mentor. Please go check them out at markettaker.com, technitrader.com, and moneymentor.com. Thank you again.